The S&P 500 just completed a strong start to the year, and the Nasdaq saw its best first half start to a year in 40 years. The S&P 500 climbed 16%, with the Nasdaq climbing more than 30% through the first half. The real estate sector, on the other hand, eked out just a 1% gain. REITs are a sector that have been under intense pressure for much of the past year, as rising interest rates have not done them any favors. However, one reason I love REITs is not just because I can gain exposure to the real estate market, but rather that all REITs are kind of thrown into the same bucket. But there are very drastic differences between the largest and most high quality REITs and the rest of the bunch. As such, it provides opportunities for stock pickers like myself. When it comes to REITs, I skip the ETF route and instead stick with a dozen or so of the highest quality REITs, building my own mini ETF. With that being said, in today's video, we are going to go value hunting in the REIT sector and take a look at 4 high quality but cheap REITs to take advantage of. So if you are ready, do me a huge favor and click that like button down below, as I truly appreciate it and it really helps the growth of this channel. Also consider subscribing to the channel so you are notified anytime we drop a new video or have one of our live sessions. With that being said, let's jump into the video. Hey dividend investors, if this is your first time joining the channel, my name is Mark Rusin. I am a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me take a quick moment to thank today's video sponsor, which is MooMoo. With the second quarter coming to a close, we will soon embark on yet another earnings season. And one of the main tools I like to use within MooMoo is the earnings calendar, which you can find by clicking on the Markets tab down at the bottom of the screen, and then under the Explore tab, which you will then see earnings reports, which you can click on and see the stocks that are reporting in the coming days and weeks. Right now, if you open a new account with MooMoo, you can get yourself some free stocks and free cash to invest in. If you deposit $100, you will get 5 free stocks with a $100 cash reward to use towards investing. If you deposit $1,000, you will get 15 free stocks and that $100 cash reward. And finally, if you deposit $5,000 or more, you will get a total of 15 free stocks, the $100 cash reward, plus 1 full share of either Tesla or Google stock. Make sure you use the link down in the description below, as this promotion is only valid for a few more weeks. Now back to our video, taking a look at 4 cheap REITs to take advantage of. And REIT number 1 is Alexandria Real Estate, stock ticker ARE. Alexandria Real Estate is an office REIT, but not your traditional office REITs. Traditional office REITs have been crushed and hammered in the market, especially since the pandemic. Many of these businesses have moved to flexible or remote work arrangements, which has drastically decreased the demand for traditional office. Alexandria Real Estate has a market cap of nearly $20 billion, and over the past 12 months, the stock is down 20%, and year to date, it is down 19%. So much of that damage has been in 2023. A few reasons we are seeing Alexandria Real Estate under pressure. Number 1 being higher interest rates. Those don't do REITs any favors. Number 2, they're being mixed in with traditional office REITs, as I just mentioned. And number 3, this is a more recent topic. Activist investor Jonathan Litt has recently put out a short report covering Alexandria Real Estate. In his report, Jonathan Litt is stating that essentially Alexandria is just another office REIT, which is wrong from my point of view. ARE is not just another office REIT. They're an office REIT for some of the most trusted life sciences companies like Bristol Myers Squibb, Moderna, and Eli Lilly, just to name a few. He based much of his conclusion based on cell phone data entering and exiting the ARE buildings, showing they were down upwards of 50%. He also mentioned upcoming lease maturities that are coming to an end and how Alexandria's cap rates compare to others within the office space. Again, Alexandria is not your typical office REIT, and that is shown in the data based on the cap rates that we are seeing. And for those of you unaware, a cap rate is simply taking the NOI for 1 year and comparing that to the value of a building. A lot of folks that are going to be acquiring a new building look at cap rates, and they can use these as comparables from one building to the other. Here's a look at Alexandria's portfolio and where the company's revenues come from. The largest exposure is to the life sciences industry, followed by multinational pharmaceutical and public biotech companies. These are not the type of companies that can necessarily work remote. In addition, 90% of the top 20 tenants are investment grade quality, with an above 80% retention rate. In a time when tenants are heading for the doors and remote work is taking over, one would think rental rates would be crashing. That has not been the case for Alexandria Real Estate, as they saw the largest rental rate increase in the company's history in Q1. That right there should tell you how Alexandria differs from traditional office. Traditional office is certainly not claiming this stat. Over the years, Alexandria has consistently raised their dividend with a 5-year dividend growth rate of roughly 5%. Given the sell-off, the dividend yield currently sits at 4.4%. The company has been increasing their dividend for 14 consecutive years and counting. And given that sell-off, shares of Alexandria are now trading at very cheap levels, with a 2023 AFFO multiple of just 16.4 times. For comparable purposes, over the past 5 years, shares of ARE have traded at an average AFFO multiple of 27.4 times, and over the past decade, closer to 25.2 times, so well below the company's historical averages. Analysts seem to agree as they rate the stock a strong buy with an average 12-month price target of $160, implying 38% upside from current levels. REIT number 2 is Realty Income, stock ticker O, and Realty Income is far and away the most popular REIT on our list today, and really, period. After all, the company is widely known for their monthly dividend. After all, they coined themselves the monthly dividend company. Realty Income is a net lease retail REIT with a market cap of $40 billion. Over the past year, shares are down 12% and year-to-date down 6%. When it comes to consistency, Realty Income is right there. They have been through various economic cycles, but still managed to find their way through and come out stronger. As you can see here, since going public in 1994, Realty Income has a compounded annual total return of nearly 15%. They have seen 26 out of 27 years of positive per share growth. How's that for consistency? And they have a 5% median AFFO per share growth rate. So the growth is not going to knock your socks off, but the consistency is why people invest in a company like Realty Income. You need stocks you can rely on. In addition, they have an A- credit rating with a portfolio of more than 12,000 properties that are leased out to 1,259 tenants. Operating as a REIT, it is important to have great properties in great locations, but you also need to have great tenants. Here's a look at the company's top 20 tenants, with many notable names including Dollar General, Walgreens, 7-Eleven, FedEx, CVS, Walmart, Tractor Supply, Lowe's, and Kroger, just to name a few. The top industries include grocery, convenience stores, and dollar stores, all well insulated from any economic slowdown. The property type breakdown is as follows. 82% of annualized rent comes from retail, 13% industrial, 3% gaming, and 2% other. In terms of the dividend, Realty Income, as I mentioned at the start, pays a monthly dividend. The dividend currently yields 5.1%, and the dividend has been increasing for 29 consecutive years, making the REIT one of the few REITs on the Dividend Aristocrat list. In terms of valuation, Realty Income, due to its quality, tends to trade at a premium. Over the past 5 years, shares of O have traded at an average AFFO multiple of 19.4 times, and over the past decade, at an average of 18.8 times. Compare that right now, you can pick up shares of Realty Income at an AFFO multiple of just 15 times, well below their historical averages. Analysts tend to agree as they rate the stock also a strong buy, with an average 12-month price target of $70.45, implying nearly 17% upside from current levels. The third REIT on our list is Agree Realty, stock ticker ADC. Agree Realty is another net lease REIT built eerily similar to that of Realty Income, which is what we just looked at, but much smaller in size. The company has a market cap of $6 billion. Over the past year, shares are down 9%, and year-to-date, they are down 7%. Agree Realty has a property portfolio of more than 1,900 properties within 45 states. Like Realty Income, the REIT also focuses on high-quality tenants, with 68% being investment grade, even higher than that of Realty Income. One of the things I like about net lease REITs like Realty Income and Agree Realty is they tend to enter into long-term leases with built-in rent escalators that are either fixed or tied to CPI. For Agree Realty, they have a weighted average lease term of nearly 9 years. Over the past 5 years, the stock has a total return of nearly 75%, with a 12.3% compounded average annual total return since going IPO in 1994, the same year Realty Income went public. Here's a snapshot at the company's portfolio. Top tenants include the likes of Walmart, Dollar General, Tractor Supply, Kroger, CVS, Hobby Lobby, and Lowe's, many similar tenants we saw on the Realty Income list. The top 20 tenants account for 56% of annual base rent. The largest sector exposure for the REIT is grocery, followed by home improvement and tire and auto, those three making up nearly 30% of the entire REIT. The company also has a strong balance sheet and has no large amounts of debt due until 2028. Agree Realty has also placed an emphasis on growing their dividend, something they have done for 10 consecutive years now, and they have a 5-year dividend growth rate of 6.7%, and the stock currently yields a dividend of 4.4%. Shares of Agree Realty also look quite cheap at current levels, with analysts looking for 2023 AFFO of $3.95 per share, which equates to an AFFO multiple of 16.5 times. For comparative purposes, over the past 5 years, ADC has traded at an average multiple of 20.7 times, and over the past decade, shares have traded closer to 18.3 times. Analysts again agree as they rate shares of ADC a strong buy with a 12-month price target of $75 and change, implying 14.5% upside from current levels. The fourth and final REIT on our list today is American Tower, stock ticker AMT. And for those of you unaware, American Tower is the leading cell tower REIT on the market. The company has a market cap of $90 billion, making it the largest on our list today. And over the past 12 months, the stock is down nearly 25%. Year to date, the stock is down 9%. This stock may be the largest of the group, but it's also the worst performing as well. Similar to other REITs, rising short-term interest rates have impacted the REIT sector as a whole. In addition, American Tower acquired data center REIT CoreSite for $10 billion, which investors were not all that crazy about, more related to timing and the floating rate debt that came along with it. Another negative for American Tower, which can be seen as a positive at times, is the fact that you gain global exposure when you invest in AMT. However, over the past 12 plus months, the negative impacts from foreign currency has weighed on the stock. Management is aiming for consistent 5% AFFO growth through 2027. The largest tenants for the company include the likes of Verizon, AT&T, and T-Mobile. This day and age, cell service and data is a requirement as everyone is connected one way or another, and with the rollout of 5G, the growth remains as the fast band with 5G does not travel as far, providing for higher demand levels moving forward. And the crazy part is, mobile data is not expected to slow down anytime soon. Over the years, the company has done a great job at not only increasing top-line revenues, but also EBITDA and AFFO. Since 2012, the property segment revenue has grown at a 14.1% CAGR, adjusted EBITDA growing at 13.4% CAGR, and AFFO a 12.4% CAGR. These strong metrics have helped produce strong dividend growth, something that makes this REIT very unique. Given the structure of REITs in general having to pay out 90% of their taxable income to shareholders in the form of dividends, you don't often see REITs with strong dividend growth. But AMT has bucked that trend as they have a 5-year dividend growth rate of 13.3%, and they've been increasing their dividend for 11 consecutive years. AMT shares currently yield a dividend of 3.2%, and they are widely considered a dividend growth stock. In terms of valuation, AMT shares look very cheap relative to their historical averages. Over the past 5 and 10 years, shares of AMT have traded at an average AFFO multiple of 25.7 times and 22.8 times respectively. Right now, shares of AMT trade at a 12-month AFFO multiple of just 18.3 times, well below their historical averages. Analysts also agree yet again as they rate the stock a strong buy, with an average 12-month price target of $237.71, implying more than 20% upside from current levels. So there, we just looked at 4 REITs, and all analysts tend to agree as they rate all 4 of these REITs a strong buy, with sizable upside from their current levels. Down in the comments section below, let me know which of these 4 REITs are you most comfortable investing in right now for the next 12 months plus. And if you enjoyed the video and haven't done so yet, make sure you smash that like button down below as I truly appreciate it, and we'll see you in the next video. Take care.